Hi everyone, welcome to TYG Trading. Disclaimer, this is not advice neither invitation to make an investment. Everything is done here for the purpose of education only. Trading is an activity that involves with risk of losing funds in your trading account, fully or partially. Always do your own research before making any financial decision. For current episode, it will take quite a long time. I will try to explain it as simple as possible, so let's start now. Liquidity is always changed over time. We can't clearly see them unless we are trading in the spot market. Luckily, for high liquid instruments, just like currency, commodity, we can estimate the liquidity area. Liquidity can be seen through bookmap. However, bookmap can't be accessed by everyone. So, we can only use technical analysis to know the liquidity area. It wouldn't be 100% accurate, but 90% accuracy is more than enough. So, what do we need to find liquidity area? Simple. We only need support and resistance, market range, market phase, and patterns. I had explained those in my previous content. I just repeat a little bit to refresh the idea. From my previous contents, we already know market structure. In market structure, we can conclude the relation of current price with latest support and resistance, market range, patterns, and market phase. From here, we then know where is the buyer and seller zones, and this leads to understanding where to open a position based on particular market positions, which can be a breakout, correction, or reversal. These are what we have up to now. Now we try to analyze further to know better about risk from each of them. Before we start the discussion about liquidity area, there are two more things we need to know. As I had mentioned before, I explained a bit about ranging. It is not about market range. It is a condition when market in a consolidation mode. Let's look at the chart to understand what ranging means here. Using the principle of market phase, we look for higher high, higher low, or lower high, lower low. We can identify market is trending or sideways by using them. From the chart, we have an area with a higher high and higher low, or lower high and lower low. This area are ranging zone. Yes, they are sideways market. Why we change terminology to ranging, not just using sideways? Defining trending or sideways will easily make us confused when we talk about liquidity. Because when we deal with liquidity, we will hop from one time frame to another. When we see trending in one chart, it can be sideways in others. So it is better to change the terminology here, especially for beginner. Let me see Euro USD daily chart. The chart is showing a downtrend. At 4-hour chart, we have uptrend. On 1-hour chart, it is also an uptrend. On 15-minute chart, it is moving sideways. When we tell others about this, it won't be helping, giving headache instead. So, how do we explain it? Let us use the rule to analyze the chart. Using price action, daily chart is telling downtrend, indicates by lower low and lower high. From daily chart, we have support and resistance, we get market range. Market is moving up now inside the range. So we can temporarily conclude market is in correction mode. We move 2 lower time frame. For our chart, price action tells it is an uptrend. 1 hour chart also shows the pattern of ranging nicely. Then, what can we conclude from here? The summary is Euro USD is under a downtrend. It is being corrected under 4-hour chart. Since market is ranging nicely, market is moved by speculator since institution is waiting for fundamental data. Since no influence from fundamental, trader who don't like high risk can hop in for few pips. Market is easier to predict, but the profit won't be big. See, we can use it to explain market conditions better. Before we talk about liquidity, we need to know price movement in the market will always ending by ranging. We can say trend and sideways is switching each other. During sideways, price is moving in a range. We call it ranging. When it is ranging, market is preparing a new base for price before an action. From here, we may hear something about drop, base, and rally. The principle is still about trend and sideways. Uptrend is rally, downtrend is drop, sideways is base. Again, simple, right? Finally, before we really touch liquidity, we need to understand about the nature of price action. The nature of price action is recursion. Most people call it is fractal. Anyway, the most important thing is the meaning. It means when we open a structure, there is another structure inside. So bigger market structure is created by small market structure inside. It is similar with how I explained about Euro USD early on, from daily chart down to 15-minute chart. Now it is time to talk about liquidity. Liquidity is highly related to historical patterns of an instrument. Every instrument has their own way to spot liquidity. When you have a well-established strategy for Euro USD, when you use it on XAU USD, it will mostly fail. You need to adjust the strategy based on XAU USD's patterns. Just like now, I explained everything in Euro USD. It will be applicable mostly for Euro USD. For others, we need to do adjustment. To apply in other instruments, we have to observe the patterns and compose the rule accordingly. For example, I trade 52 instruments in total. Most of them have different rules. Now I will explain about the rule to spot liquidity. Again, we will use support and resistance. There are two types of support and resistance, major and minor, or now popular by using strong support and resistance and weak support and resistance. Next is market structure. It is also major and minor. Some will say external and internal. Finally, the liquidity based on pattern and market phase. There are also major and minor liquidity zone. Liquidity area will be vary based on market phase and pattern. I don't combine patterns in allocating liquidity for now. I will base on market phase only. In short, liquidity is simply an area of overbought and oversold. The area becomes significant or not will be rely on market phase and structure. When we only do analysis on one time frame, the liquidity will be look simple. For example, here, during uptrend, the oversold area is a lower part of the range. You can see this is our buy zone. During downtrend, the overbought is an upper part of the range. Here is our sell zone. When market is moving sideways, the overbought and oversold will be the upper and lower part of the range. Simple, right? Now the real challenge is when we do it for multiple time frame analysis. Multiple time frame analysis can be done by single instrument, multiple time frame, or multiple instrument, multiple time frames. Now we focus on single instrument, multiple time frame only. Multiple time frame strategy will let us see market comprehensively. It can be done by single chart or multiple chart. Multiple time frame analysis on single chart means we see the price movement of other time frame from one chart. For example, we use hourly chart to analyze price movement of hourly and daily time frame. It is also possible to see price movement below hourly chart. Multiple time frame analysis on multiple chart means we see price movement of different time frame by opening several charts different time frame. So if we want to analyze daily, hourly, and 15-minute price movement on an instrument, we have to open 3 charts with those time frame. For beginner, it's better to start multiple time frame analysis by using multiple chart. It has been too long now. I will continue this topic on next episode. How do we analyze market liquidity by using price action? Don't miss out the next episode. TYG out. If you enjoy my contents, feel free to subscribe and a like will be very much appreciated as well. You may also leave questions in the comment section. I will try my best to answer honestly.